This is the story of a man who built rockets while his bank account was collapsing, who launched cars when critics were predicting bankruptcy, and who faced a year so brutal that even he later called it the worst of his life. This is the story behind the risk that nearly broke Elon Musk. Before the headlines, before reusable rockets landed upright on floating platforms, before electric cars became symbols of the future, there was a sequence of decisions that placed everything on the line. To understand the risk, we have to rewind to a time when the world did not believe in private space companies, when electric cars were seen as slow and impractical, and when one entrepreneur decided to bet almost every dollar he had on ideas most people called impossible. In the early 2000s, after selling PayPal to eBay, Elon Musk walked away with significant personal wealth. For many entrepreneurs, that would have been the finish line. A comfortable life. Investments. Maybe philanthropy from a distance. But Elon Musk was not interested in comfort. He was thinking about existential problems, sustainable energy and the long-term survival of humanity. Instead of diversifying his money into safe assets, he did something unusual. He split it between three ambitious ventures: an electric car company called Tesla Motors, a private rocket company called SpaceX, and later a solar energy company called SolarCity. Each one, on its own, would have been considered high risk. Together, they formed a portfolio that looked reckless. Let's start with SpaceX. In 2002, the idea of a private company building orbital rockets sounded unrealistic. Space exploration was dominated by government agencies like NASA and large aerospace contractors. Rockets were expensive, complex, and prone to failure. Musk believed that costs could be reduced dramatically through vertical integration and engineering focus. But belief does not guarantee success. SpaceX's early years were filled with uncertainty. The company developed the Falcon 1 rocket, a small orbital launch vehicle. The first launch attempt in 2006 failed. The second attempt also failed. The third attempt in 2008 failed again. 3 failures in a row would crush most startups, especially in aerospace. Rockets are not apps. They do not fail quietly. They explode on live streams. Each failure burned not only hardware but also millions of dollars. Internally, morale was tested. Externally, critics were relentless. By this point, Musk had invested a large portion of his personal fortune into SpaceX. He was not just the founder. He was the primary financial backer. And money was running out. At the same time, Tesla was struggling. Founded in 2003 by Martin Eberhard and Mark Tarpenning, Tesla aimed to prove that electric cars could be desirable and fast. Elon Musk joined as an early investor and later became deeply involved in leadership. The company's first vehicle, the Tesla Roadster, was innovative but plagued with production delays and cost overruns. Building a car company from scratch is notoriously difficult. It requires manufacturing expertise, supply chains, regulatory approvals, and massive capital. By 2008, Tesla was facing internal conflict, engineering challenges, and rising expenses. The global financial crisis was unfolding, and capital markets were tightening. Investors were cautious. Cash was scarce. Imagine the pressure: 2 capital-intensive companies, both burning money, both facing technical setbacks, both operating during a worldwide financial meltdown. By mid-2008, the situation became critical. SpaceX had only enough funds left for one more Falcon 1 launch. Tesla was close to running out of cash and struggling to meet payroll. Musk later described this period as a time when he was borrowing money for personal expenses and sleeping on friends' couches. The risk was no longer theoretical. It was personal. Here's what made the situation so extreme: Musk had essentially put nearly all of his PayPal earnings into these ventures. Instead of protecting his wealth, he concentrated it. If SpaceX failed and Tesla collapsed, he would not just lose reputation. He could lose his financial security. The fourth Falcon 1 launch in September 2008 was not just another test. It was, in many ways, a last chance. If it failed, SpaceX might not survive. Engineers worked intensely, refining systems and correcting previous errors. The team understood the stakes: When Falcon 1 finally reached orbit successfully, it marked the first time a privately developed liquid-fueled rocket achieved orbit. It was a technical milestone and a psychological breakthrough. But even that success did not immediately solve the financial crisis. Shortly afterward, SpaceX secured a NASA commercial resupply services contract. This contract, worth over $1 billion over time, provided a lifeline. It validated the company and gave it a path forward. Meanwhile, Tesla faced its own near-collapse. In late 2008, Tesla was days away from bankruptcy. Musk made the decision to invest his remaining personal funds into the company. He also sought emergency funding from investors. Negotiations were tense. The timing was brutal, the global economy was in recession, and investor confidence was low. On Christmas Eve 2008, a funding round closed just in time to keep Tesla alive. It was not a triumphant victory. It was survival. Why did this period nearly break Elon Musk? Because the risks were layered. First, there was financial risk. He had concentrated his wealth in high-risk ventures. Conventional wisdom says diversify. Musk did the opposite. Second, there was reputational risk. Public failures in rocketry and automotive manufacturing are highly visible. A collapse could have labeled him as overly ambitious or irresponsible. Third, there was psychological risk. Leading teams through repeated failures while personally facing financial strain is mentally exhausting. Entrepreneurs often talk about resilience, but resilience under that level of pressure is rare. Fourth, there was systemic risk. The global financial crisis amplified everything. Investors were pulling back. Credit markets were unstable. Even strong companies were struggling, let alone startups building rockets and electric cars. The narrative often simplifies success. It compresses years of uncertainty into a highlight reel. But the reality is that for a period in 2008, it was entirely plausible that both SpaceX and Tesla would fail. Let's pause here and analyze something important. What kind of decision-making leads someone to take such risks? Elon Musk's approach has often been described as first principles thinking. Instead of accepting industry norms, he breaks problems down to fundamental truths and reasons up from there. For rockets, he analyzed the cost of raw materials and concluded that rockets should not be as expensive as they were. For electric cars, he believed battery costs would decline over time, making EVs competitive, but first principles thinking does not eliminate risk. It reframes it. Musk was not gambling randomly. He believed that if he could solve key engineering problems, long-term value would follow. The short-term pain was, in his view, a necessary phase. Still, belief is not enough. Execution matters. After surviving 2008, both companies entered new phases. SpaceX moved forward with the Falcon 9 rocket and the Dragon spacecraft. Over time, it achieved multiple successful launches, cargo missions to the International Space Station, and eventually crewed missions. The development of reusable rocket technology dramatically reduced launch costs and altered the economics of spaceflight. Tesla launched the Model S in 2012, which received critical acclaim and changed public perception of electric vehicles. It proved that EVs could be high-performance, desirable, and commercially viable, but survival did not mean the end of risk. In 2017 and 2018, Tesla faced what Musk called production hell during the ramp-up of the Model 3. The company struggled with automation bottlenecks, manufacturing delays, and intense scrutiny from investors and media. Once again, bankruptcy fears resurfaced. During this period, Musk reportedly slept on the factory floor to oversee production. The pressure was immense. Short sellers were betting against the company. Analysts questioned whether Tesla could scale manufacturing profitably. The pattern repeated: high ambition, operational challenges, public skepticism, and existential pressure. Why does this matter? Because the story of the risk that nearly broke Elon Musk is not just about one dramatic year. It's about a pattern of operating near the edge. High-risk entrepreneurship often involves pushing systems to their limits. When you are trying to disrupt entrenched industries, automotive, aerospace, energy, you are competing against established players with deep pockets and decades of experience. The margin for error is thin. Musk's leadership style has also been a factor. He is known for setting aggressive deadlines and demanding high performance. Supporters argue that this urgency accelerates innovation. Critics argue that it creates burnout and instability. Both perspectives highlight the intensity of the environment. From an educational perspective, there are several lessons here. Lesson 1: Concentrated risk can create concentrated outcomes. By focusing his resources on a small number of transformative ideas, Musk maximized both downside and upside. It is not a strategy suitable for everyone. It requires high tolerance for uncertainty. Lesson 2: Technical competence matters. SpaceX did not survive because of optimism alone. It survived because engineers learned from failures and improved designs. Tesla did not succeed on branding alone. It succeeded because battery technology, software integration, and vehicle design reached competitive levels.